Hey everyone, it's Dan here. In this video, I'm going to talk about a unique type of investment which has generated higher returns than the stock market over the past 20 years. I'm talking about real estate investment trusts, or REITs. So here's the outline for the video. I'm first just going to talk about what are REITs and how they're different than stocks. Next, we'll talk about the pros and cons of investing in REITs. Third, I'm going to talk about what are some things you need to look at when deciding on whether a REIT is a good investment or not. Finally, I'm going to talk about whether right now is a good time to invest in REITs, and I'll give you my picks for the top REITs I'm interested in. If you're new to the channel, my name's Dan. I'm a business school professor interested in accounting and finance, and the purpose of this channel is to help you get rich through saving and investing. So if you like money, hit that subscribe button. So what are REITs? Well, REIT stands for Real Estate Investment Trust. So it is a trust. It's not really a stock. It behaves somewhat similar to a stock in that you get dividends from it. Now, the nice thing about REITs is that they are required by law to pay out at least 90% of their net income as a dividend every year. So unlike stocks, which may reinvest a lot of their money, with REITs, you're guaranteed a very healthy dividend payment. Now, as you can see from the chart, if you invested your money in REITs 20 years ago, you would have earned an average annual return of 9.9%, far outclassing any other asset class, including the stock market. Now, just in case you think I'm cherry-picking this 20-year window, let's have a look at this chart here. So if we look at a different window, say starting from 1996, you can see REITs have trounced the S&P 500 over that period as well. Look at the past 10 years, REITs have also beat the S&P 500. Now, when you look at the past couple years, the stock market has been running hot. As you can see, REITs have been lagging the stock market. But in the long run, REITs are going to do pretty well. Now, there are several types of REITs. You can invest your money in a retail REIT. They own mall space, they own retail properties, they own hotels, and they earn money basically by leasing these spaces out to tenants. They usually have long-term leases, anywhere from 10 to 25 years, with fixed price increases every year to keep up with inflation. It's kind of similar to that. You have healthcare REITs, which own hospitals, they own nursing homes and things like that. A little bit different flavor of REIT is residential REITs. As the name suggests, they own apartment complexes and things like that. It's a very different animal there because you've usually got 1-year leases. You've got mortgage REITs, which we won't cover heavily in this video. They're very different. They don't actually own any real estate property. They simply buy the mortgages or even just the mortgage-backed securities and make money in that way. Okay, so let's talk about some of the pros and cons of investing in REITs. One of the major advantages of investing in a REIT is the low volatility they offer. It's a very predictable and stable business. You buy property, you rent it out to people, and you collect the money. So while I did mention that REITs have outperformed the stock market over the past 20 years, what I failed to mention was they've done so with lower volatility. A second major advantage of putting your money into a REIT is that it's a natural hedge against inflation in the long run. So no matter what kind of property the REIT owns, in the long run, they'll eventually be able to raise their rents. And if no one will take their property, if no one will rent the space, if inflation goes up, they will be able to sell it at a higher price than they bought it for. So no matter how you look at it, it's a good hedge against inflation. One last positive thing I'll say about REITs is that they are not corporations, so they are not subject to double taxation. So usually for a corporation, they need to pay their corporate tax, and then with the money they have left over, they can give it to shareholders as a dividend, and you as a shareholder then have to pay taxes on that. So we call that double taxation, and with REITs, they don't have that. So they basically have no income tax expense on their income statement. This is one of the major reasons they've been able to outperform the stock market. Okay, let's talk about the drawbacks of investing in REITs. Number one drawback by far is taxation. So when you get a dividend from a REIT, it is not a corporation, so it's actually called a distribution. And what that means is you're going to be taxed like it's ordinary income. So whatever tax rate you pay for the income you make from your job, that's the tax rate you'd be paying on the dividend you get from a REIT. Now, I don't know how much money you make, but whatever that number is, your tax rate's usually going to be higher than the tax rate on dividends. Now, an easy way to overcome this is just to only invest in REITs in your retirement account. So if you have any type of retirement account, your money grows tax-free, and you don't have to worry about this disadvantage. Another drawback of REITs is that you're never going to have an extremely high return. It's a very steady and stable business. You're going to get rich slowly. It doesn't have the upside potential of a Tesla or an Apple or something like that. A third drawback of the whole structure of REITs is actually their 90% payout rule, where they have to pay out 90% of their profits as dividends. Because of this, when a REIT wants to invest in new property, they often have to raise either debt or equity financing. And if they can't borrow the money, they're going to issue additional shares, which dilutes the ownership. This obviously hurts you as a shareholder. Okay, so if you're interested in investing in REITs, how do you decide whether a given REIT is a good investment or not? Well, if you saw my video on the price-earnings ratio and how to apply that to decide if a company is a good buy or not, we're going to use the same approach with a REIT, but we have to be very careful here. Looking at a REIT's price divided by its net income or earnings is usually very misleading. The reason is that a REIT's net income includes all the gains and losses from buying and selling real estate, which are really temporary fluctuations. What you're more interested in is what are the true earnings that are going to be recurring in the future. So most people that analyze REITs make a little adjustment to net income to get a number we call funds from operations. They take the net income and they add back the depreciation, and they add or subtract back any gains or losses from sales of real estate during the year. Depreciation is usually added back because most REIT investors feel that the depreciation expense is not reflective of the actual depreciation of the property. So once we have funds from operations and we can use that as our pseudo earnings number, we then can look at price to FFO ratios and value the REITs the same way we would with a price to earnings ratio. So the way we'd look at it is, for a given level of funds from operations or pseudo earnings, how much does the REIT cost? So for example, a price to FFO ratio of 12 would mean that we're paying $12 for a company that earns $1 a year. Okay, here are my final thoughts on the timing of investing in REITs right now and which REITs I like. So first of all, yes, I do think it's a great time to get into REITs, and I'll tell you why. The number one reason is that the Federal Reserve has slashed interest rates to zero, and if you saw Jerome Powell's announcement the other week, they've essentially committed to keeping rates low for the foreseeable future. The thing you got to understand about REITs is that they thrive in low interest rate environments. This is one of the reasons that REITs have outperformed the stock market over the past 20 years. It's because we've had historically low interest rates. If we look over the past 40 years, REITs have not outperformed the stock market, and the reason is higher interest rates. REITs benefit from low interest rates in a few ways. Number one, debt is cheap. They can borrow easily. This allows them to expand their operations cheaply. If interest rates go up dramatically, I'm talking 4 or 5%, REITs become a much less attractive investment. The reason is, if you can get 4 or 5% just by buying some bonds, why would you take the risks associated with owning real estate? So if rates do go up dramatically, you're going to see people just get out of REITs and get into other things. So the price of those REITs will fall. But given that that doesn't seem to be likely to happen anytime within the next 5 years, I see now as a pretty good time to put your money into REITs. My second reason for recommending REITs is that the Fed is printing money like there's no tomorrow right now. They're pumping tons of money into the economy. So with all this money pumping, at some point we're going to have some inflation. Now, when inflation comes, if you have your money in stocks, they may do well or they may not. It depends on what you own. Some companies have that pricing power. They can increase their prices and pass it along to their customers, and they won't lose any customers. But for other companies, that's not the case at all. The bottom line is, with inflation likely coming, I feel pretty safe to put my money into some REITs. I'm putting a link in the description below to a great website where you can search for REITs. Anyhow, since I recommend residential REITs, here are a few that I think you might be interested in. Here's Independence Realty Trust, based in Philadelphia. They have a market cap of about $1 billion, and they invest in residential properties around the Philadelphia area. They have a price to funds from operations ratio of about 14.5, and they're currently yielding close to 6%. So what that means is, if you put $100 into the company, you'll get $6 every year. Another one I like is Apartment Investment and Management Company. They're valued at about $5.7 billion. They've got a price to FFO ratio of about 14, and they're yielding about 4.7%. As you can see from the price chart below, they really took a big hit with COVID, but again, they have good collection rates from their tenants, and so I think this is a case of the market throwing out the good with the bad. Another solid REIT is AVB, based out of Virginia. They're yielding about 4.25%, and they trade at a price to FFO ratio of about 16.6. Similar to the last one, you can see that they've taken a huge price hit this year. Okay, so now that we've talked about those solid REITs, let's talk about some riskier REITs that have a lot of upside potential. The first one is Preferred Apartment Communities. They're trading at a price to FFO ratio of about 6.5. Very low, very deeply discounted. And you can see from the price chart here, their stock price has absolutely tanked over the past year. They're at the point now where they're yielding 13.66%. So if they can keep that same dividend rate up, you'll get your money back after just about 6 years of holding the stock. Finally, there is one retail REIT that I'm interested in, and that is Simon Property Group. They're one of the biggest players in the industry with a market cap of about $22 billion. They're very well diversified, and they're trading at an extremely steep discount right now, with a price to FFO ratio of about 6.5. This company has excellent management, and they've been around a long time, and they're yielding 11.85% right now. The risky thing about this investment is that SPG primarily owns retail space, like malls. Now, in my opinion, they are diversified enough that I am not really worried about the malls going vacant for a little while. Again, they have excellent management, and I'm sure they can find a use for that space at some point or sell it for a profit. Overall, I just think they're set up for success at this price. But it would be misleading for me to say that this is a slam dunk investment. This is definitely a risk. A lot of it comes down to how you think consumer behavior will change or won't really change after the whole COVID lockdown is over. Alright guys, that's all I have for this video. Please hit the subscribe button if you haven't already. Thank you.